Assalamu alaikum and good afternoon. Students, I hope all of you are fine. I'm going ahead with the next chapter. Inshallah, this will be the last chapter for the semester, which is non-current liability. Last chapter, we were talking about current liabilities, and I'm sure you remember that current liabilities are those liabilities that the company is obligated to make payment to before 1 year, isn't it? The opposite of that would be non-current liabilities, which mean the obligations of the company which is not yet due within a year, but anything beyond 1 year. In fact, the company has more than 1 year to make the repayment. In this chapter, inshallah, we'll be talking about different types of non-current liabilities. The main ones are, excuse me, bond payable and note payable. So again, bond payable is an instrument which the company uses to borrow money from the public, that is more than a few number of lenders, while note payable is nothing but an obligation where the company actually borrows money by making a promise to make a fixed amount of payment at a particular point in time. We'll also be talking about extinguishment of these non-current liabilities. Extinguishment means when they actually been paid, okay? And then finally, we talk about the presentation and analysis of these non-current liabilities. Now, let's note one thing here. What I've done is in order to make the learning manageable for you within the last 2 weeks of the learning in this semester, I have reduced the content by removing the exercises for the long-term liability. So I'll just discuss long-term liability theoretically while we'll do the bonds payable, inshallah, in a bit of detail. Okay. So with that, let's go ahead. What are bonds payable? Bond payable is a non-current liability, that is, it's a long-term debt which consists of expected outflow of resources which arises because of present obligation and they are not payable within a year or within a particular accounting cycle, whichever is longer. Fine. So some examples of bond payable could be some example of non-current liability could be bond payable, long-term note payable, mortgage payable, pension liabilities, lease liabilities, and so on. One thing we also need to remember whenever we talk about long-term liabilities is that when a company borrows money for a long term, usually they get obligated to the lender. The lender will make certain conditions. Maybe the lender may say that on the whole, the company should not borrow more than so and so amount, or maybe sometimes the lender could even say, could put in some restrictions to the company that they cannot do this type of business or maybe operate in this type of market and so on. So this is something which we just need to mention here is that bond payables are mostly covered by some covenants or there could be some restrictions which the company need to follow. Now, why we are mentioning this in this course is because we are talking about what and how we need to uh, report to the readers of the financial statement. So when we report the long-term liabilities on the balance sheet, the readers may also want to know, okay, you have a long-term liability, but are there any restrictions or conditions uh, tagged along with that, wasn't it? Right? So we'll go on with the types of bonds. First of all, I just put up a timeline here to remind ourselves of what a bond means. If you remember from your previous classes, you even learnt about bonds in financial management class. Of course, you did that in your accounting 2 classes. So here, let's say if I'm putting the ingredients of the bonds on a timeline. So let's say today the company is going to sell the bond at a particular price by promising to make a particular payment at maturity of the bond, and that particular payment would be called as the face value. In between, that is the interim periods, in this example it's 4 years, so maybe the company plans to give an annual interest which is called as coupon. Okay, I'll put a short form here, CPN, coupon, which is nothing but the interest which the company has promised to pay to the bondholder regularly. It is the interest that the company would be paying to the bondholders. It could be paid annually or it could be paid semi-annually. I just hope you remember this component of the bond as we go further. Right. So depending on the way in which, or the agreement with which the bond has been issued, bond can have many different varieties. So let's talk about each one of them here. The first classification is called secured bonds and unsecured bonds. Now, secured bonds are those bonds which has an extra promise to the bondholders that the company would be securing some part of the assets and assuring them that those asset would not be sold unless the bond has been repaid. So that means the bondholder of secured bonds will have an extra security that their money would be safe with the company even if the company gets closed. On the other side, there is unsecured bonds, which is also called as debentures, do not have any such promise. At the second level, we could differentiate different type of bonds. In this way, there could be a term bond. A term bond is that bond where the company promises to make payment at maturity. Like in this example, if you can see, the company will promise to pay the face value at the end of 4 years. So the 4 years is the term of the bond, and no payment would be made before that other than the coupon. So that is called as the term bond. While serial bond refers to if the company promises to pay this face value not in the last year, but it breaks down the payment. Let's say in the year in a half, let's say 50% payment will be made in year two, and maybe another 20% will be made in year three, and so on. If the company makes any such promise, then the bond could be called as a serial bond, where the payment is made not at one time on maturity, but rather it would be paid periodically during the duration of the bond. The next type of a bond is called as a callable bond. Now, what is a callable bond? In this case, when the company has to collect the price of the bond at the beginning of the issue, or at the 0th year, the company may not collect 100% of the price. Rather, it may collect a percentage of the price, or sometimes it may not collect any price. But while selling the bond, it takes a promise from the lenders that whenever the company needs money, the lender has to pay. So this type of bond become callable bond, and as and when the company needs money, they call for the price of the bond. So that means the price is not paid in the year zero. It could be paid in the year one, two, three, four, whatever is the duration of the bond till maturity. Okay, so this is a variation of the terms and terminology of the bond. So here you have three types of bond: term bond, serial bond, and callable bond. The next type of bonds can be convertible bond, commodity backed bond, or deep discount bond. Now, convertible bond are those bonds which at maturity will not pay cash to the bond holders. Rather, it will be the bond will be converted into some other form of security. Most of the time, it will be converted into common stocks. Next comes commodity backed bond. Now, under commodity backed bond, the bond is secured by some commodity. Let's say it's secured by the inventory of the company, or maybe it's secured by some security, some other securities which the company is holding, or it could even be the company has. So this type of bond which is backed by this commodity is called commodity backed bond. Then we have deep discount bonds. Now, what are deep discount bonds? If you remember your time value of money chapter from the financial management course, we understand discounting is nothing but taking the future value of a cash flow and bringing it to the present value, isn't it? So the action that is used is called discount. Now, deep discount bond is that the price of the bond is going to be very low as compared to the face value, and the company sells such bonds at a very low value, maybe because they are either not paying any coupon, okay, or maybe they are paying a very small amount of coupon. That's the reason why they have a very low price while having a fixed face value. So that's why, since they are issued at a discounted rate, it's called as a deep discount bond. Okay, so there are other conditions attached to that. Let's consider that later. Okay, so next is a registered bond and bearer bond. The word today has not much connotation. However, let's discuss the meaning. Now, if a bond has been registered in the name of a bondholder, then the bondholder cannot sell the bond to anybody else unless they also transfer the registration. Okay, in today's world, I don't know how far this will hold good, because today all trade and buying and selling of securities happen online, and it's only a digital registration that happens. While a bearer bond are those bonds which can pass on from one person to another very, very easily. Next are income and revenue bonds. Income and revenue bonds are opposite to deep discount bonds in the sense that in deep discount bonds, not too much attention is given to the coupon or the payment of interest. Rather, the benefit to the bondholder is that the bonds are available at a very price, right? However, income and revenue bonds give more importance to providing systematic income to the bondholder. That means they pay more attention to paying coupon. It's possible that the bond is sold at a very high price. However, it promises to pay regular income to the bondholder. Next, we'll talk about how the bond is being issued. Now, before the company issues bond, they have to make a contract with the bondholders or the prospective bondholders, and the contract is called as the bond indenture. Now, what is written in the indenture? Indenture is nothing but like a written contract where the company promises certain things. So, in that indenture, the company promises to pay a sum of money that is designated at maturity date. If you remember, this designated maturity value is called the face value of the bond, and the periodic interest, that is specified rate on maturity on the face value. If you remember again this word, the periodic interest on the bond is called the coupon. Fine, so it's normally having a face value of 1000 most of the time. If it's not been mentioned in the exercise or in the textbook, we always assume that the face value of the bond is $1000. Interest payment is usually made semi-annually. So the normal thing that happens in the real world is that semi-annual interest payment is made and used when the amount of capital needed is so large that one lender cannot supply the money. So what they do is they issue bonds to multiple lenders and collect money from many people. It's just like the issue of shares. Okay, now we'll see how the bonds are listed. So if you look into the financial markets, maybe you go to a bond listing in the in maybe even in uh, some stock markets, what you will actually see is this information which is listed. They will tell you who is the issuer. Issuer is the company that makes the issue of the bond. In this example, there are two issuer. One is a Vodafone company and there is a Telecom Italia. These are the two companies which whose bonds are listed in this particular screen. It tells you what is the coupon. So here coupon is the percentage that the company is promising to pay. So the coupon rate is 5 for Vodafone and 5.25% for yeah, Telecom Italia. It indicates the maturity date. Maturity date is the date at which the company has promised to pay the face value. Okay, so in this case, for this company, it's 4/6/2018 and 2/10/2022. And here they have given you the price. Now the price, in order to make it comparable, has been converted into a percentage. It's saying what's the percentage on the par value. So when you see 106.66, what it actually means is that it is 106.66% of the face value. So assume if the face value was 1000, then the price would have been 1066.6. And for Telecom Italia, it is 1000, right? And the yield which is calculated, yield is nothing but the dividend yield is the percentage return on the bond over a period of time. This is a calculated percentage which is given here, so you could say it is 4.05% and 5.25%, and also the rating for the company would be given here. I believe you understand what is a rating. Rating is the credit worthiness which is measured by credit rating companies like Standards and Poor's and Moody's. Okay, but even by looking at this this information, the the bondholder get an idea which is a safer bond. So what do you think? Is this Vodafone a safer bond than Telecom, or what do you think? Yeah, you're right. Vodafone is more safer. One thing is you could see AA rating is higher than BB plus rating, right? And secondly, if you can notice, the yield for a more safe bond is less than that of a risky bond. So you could see Telecom Italia is more risky than Vodafone. That's why the yield is also less for Vodafone as compared to Telecom. Okay, let me go ahead there. Issuance and marketing of bond to the public. So usually issuing of bond can take months, sometimes weeks in today's fast world. Issuing company must arrange for the underwriters. Now, underwriters are companies who insure the issue of the bond. For example, if the company wants to issue, let's say, 1 million bonds, there is no guarantee that all these bonds would be sold in the market. So they arrange for a bank which assures them that such type of money could be collected from the market. They also must obtain a regulatory approval for to undertake the issue, to undergo the audits, to issue a prospectus. It is just like issuing shares. If you remember when Aramco made their IPO, they had to follow so many norms and regulations. Exactly the same type of norms and regulations company need to follow when they issue bonds. They also need to get the bond certificates printed. Now, again, in today's world, many bondholders do not require bond certificates. They are happy with the digital certificate that the banks provide them with. Let me talk about the selling price and the selling price of the bond. Please pay attention because we need to have we need to understand this to go ahead with the exercises. Now, whenever the company is selling, if you remember again, the selling price is nothing but the price that the bondholder has to pay today in order to get the benefit that the company is promising and to get the payment of the bond face value at maturity, right? So now there is a relationship between the price of the bond and the interest rate in the market uh, as compared to the coupon rate which the bond will be paying periodically. So for that, we'll have an understanding that these what is the selling price of the bond is affected by many things. One is the supply and demand of the bonds from the buyers and the sellers. Secondly, the risks associated with the company, as I was explaining in the previous slide. The market conditions, of course, if the market is tight or if funds are available or not. And finally, the state of the economy. So these are the four conditions which decides the selling price of the bond. But we always need to understand that there is always um, and understanding that the price of the bond depends on how popular a particular company is with the lenders. So the investment community values the bond at the present value of the expected future cash flows. This is something which you learned in your financial management class. That is how to calculate the present values. That is the discounted value of all the future cash flows, whether it is a single cash flow or a multiple cash flow. Now, if you can remember your bond structure, note that there are two types of cash flow here. One is that the company in exchange for the price today is promising to pay a fixed amount of money on maturity called the face value. Also, the company is promising to pay the coupon, which is the same amount every single year or two times in a year, whatever you want to call it, every period, let me say. And they are the same amount for a fixed number of period. If you remember, the word that was annuity. So understand that the bond payment, or we can say the bond structure, includes two types of, I'm just trying to write annuity. Let me finish that. I'm sorry, I don't have a pen, so that's why I'm struggling to write with my mouse. Right, anyways. Okay, so this is annuity. So there is a single cash flow. Let me write CF here. There is a single cash flow and there is an annuity, isn't it? So here we would say that interest is nothing but the coupon. Coupon refers to the annuity, and principal, that is the face value of the bond, it is a single cash flow. So if we want to calculate the price of the bond, we need to calculate the present value of both these cash flows. Right, so what is the interest rate? Interest rate is the stated rate, the coupon rate, or the nominal rate. So the rate return on the terms of the bond indenture. So in the condition itself, the company says that we promise to pay so and so amount of money. It could be called as a stated rate, the nominal rate, or the coupon rate. Bond issuer sets this rate, and the stated percent it is stated on the percentage of the bond's face value. So this amount is always calculated on the face value of the bond. So if the company says we'll pay you 8%, then we have to see the face value. Imagine the face value is 1000. So 1000 into 8%, $80 will be the bond payment for coupon every single year. So what is market rate? It's also called as the effective yield. Market rate is the rate that provides an acceptable return which is commensurate with the issuer's risk. So market rate, in other words, we could say it's the rate that the lender is expecting to get from the bond. Okay, so the rate is actually earned by the bondholders, because if they don't earn that bond rate, I mean, if they don't earn that interest rate, they will not be interested to buy the bond of this particular company. They may go to some other investment avenues. So let's see, how do you calculate the amount of interest that is actually paid to the bondholders each period? So you calculate it like this: stated rate, remember this is also the coupon rate, multiplied by the face value. So this is the amount that you actually pay to the bondholder. So this, for example, let's say if 8% was the coupon rate and the face value of the bond was, let's say, 1000, then we would say that the coupon or the interest that actually comes to the bondholder's pocket would have been how much? Yes, $80. Okay, so that is the way in which you calculate the amount that you actually pay to the bondholders. However, what is the amount that you should record as interest in the income statement of the issuer? So in that case, you will be taking the market rate multiplied by the carrying value of the bond. So market rate is the discounting rate, the rate at which you want to discount the bonds, and carrying value is the value which is yet not paid, I mean the amount that is supposed to be paid to the bondholders at any particular given point. So here there is a relationship between the market rate and the price of the bond. So imagine that the stated rate, remember this is the coupon rate, if it was 8%, and at that point, let's say the market interest rate, it means other investment avenues are giving 6% returns. That means if you can see, the coupon rate is more than the market rate. That means this company is paying more coupon than any other uh, security that is available in the market. So in that case, what happens is the bond will be sold at more than 1000. In other words, it will be sold more than the face value. This situation is called as issue at a premium. Okay, so you could see here, when the coupon rate is more than the market rate, the bond will be issued at a premium. Second situation, if the coupon rate is equal to the market rate, then what happens? Yes, bond is issued at a par. On the other side, if the coupon rate is less than the market rate, means people are going to come to you only if you, I mean, in this case situation, what has happened? The Your bond is paying less in terms of coupon while the market rate is higher. So in order to attract your investors, you need to sell your bond at a discount. Okay, so this is the situation. Okay, so these are the three scenarios. If you keep this in mind, the exercise solving will be a bit easier for you as we follow. So with that in mind, let's go ahead. Let's look at this situation here. It's an illustration. Santos SA issues $100,000 bond, some dollar bond, in dated January 1, 2019, which is due in 5 years, with the 9% interest payable annually. So you need to understand, payable annually here, it's actually representing to the coupon. At the time of the issue, the market rate of such bond is 9%. So can you see, the market rate, the coupon rate is 9%, the market rate is 9%. What do you think? What should be the price of the bond? Anybody? Yes, it should be par value. So that means the value of the, I mean, if par value is $100,000, that means the price of the bond should also be 100,000. Let's say. Okay, so let's represent that on a timeline. So let's say in the year 0, 1, 2, 3, 4, 5, the price is 100,000 and the coupon amount is 9,000. How did you get that? 9% of 100,000. Okay, so with that, if I calculated the present value of the principal, that means the PV of this 100,000 for 5 years today, it would be 100,000 multiplied by the, look at the time value table for 5 years at 9%. So this is the table value. Multiply that, it would be 64,993. And also we need to get the present value of all these payments. Remember, it was an annuity. So that means we need to check the annuity table. So let's look at annuity table for 5 years at 9% and multiply it with 9,000. What you will get is 35,007. Add that, and that is the price of your security today, price of your bond today. Okay, so as we guessed, it is the face value. Okay, let's take this example. I mean, okay, in this slide, we are showing you what is the entry they would pass. So on 1st of January, when the bond was issued, the entry would be cash debited and bonds payable credited. On December 31st, when the bond interest became due, in other words, when the coupon became due, the entry would be interest expenses debited and interest payable credited 9,000. And when the interest or the coupon is actually paid on January 1, the entry would be interest payable credited and interest payable debited and cash credited for that particular value. So let's go ahead. Let's consider this scenario. In this case, again, the same bond, 1,000, sorry, $100,000. 9% is the coupon, but 11% is the market rate. Now, what is the scenario here? 9% coupon rate is less than 11% the market rate. So when the coupon rate is less than the market rate, what will happen to the price? What do you think? Yes, then the bond needs to be sold at a discount because the market is promising a higher rate than the coupon which this bond is providing, isn't it? So, okay, fine, have a look at that. Let's also calculate it in the same way. Suppose we will do the present value of the principal amount. Notice that this time we are using the 11% discount rate. So, the present value is less than what we saw before. Similarly, for the coupon, also we apply the 11% rate, and that would be the value. So that means the price of the bond today would be 92,608, as you saw, is less than 100,000. Okay, and the entry that you pass would be cash that you receive today is 92,608 and bonds payable 92,608. And when you actually accrue the interest and pay them on 31st of December, your entry would be interest expense 10,187. Cash that you will be paying is only 9,000. Now, here, if you are recording the uh, adjusting entry, you can say interest payable. Okay, but if you're paying it on the same day, you can say cash. And then bonds payable, the difference between the two amount will be credited to the bond. Can you see here what has happened? The difference actually will be adjusted to the value of the bond. Okay, so next, if bond is selling at less than the face value, then the investors demand a rate that is higher than the stated rate. So you say, okay, fine, we are selling it at less than the face value, so we need something more, right? We need in extra or maybe an extra interest or extra coupon. Usually, it is because the investor can earn a higher uh, interest rate on investments of similar risks. Because the company cannot change the stated rate, it means once the company has decided a coupon rate, they cannot change it. So what they would instead do is they would adjust the value of the bond, that is the price of the bond. Okay, so investors receive interest at the stated rate computed on the face value, but they actually earn an effective rate because they have paid less for the face value on a bond which is paying a lesser coupon. I hope that's clear. If not, just read this slide once more. Inshallah, you will understand it. What is effective interest rate then? So if we look at the bond, whether especially when they are issued at a discount, it means the company um, would not actually be paying the same amount of interest that they have mentioned as the coupon rate. So they would be actually paying something more because now they are receiving a lesser amount. Or when the company is issuing the bonds at a premium, also the same situation arises. So adjustment is required to the cost by recording the interest expenses over the life of the bond, and this process is called amortization. If you remember, we used this word before in the chapter for PPE, that is plant property and equipment chapter, where we said that amortization is used for intangible assets, right? So similarly here we are actually considering the additional payment that you make as an interest expense and should be amortized over the life of the asset. So that's why it's called amortization. Procedure for amortization, that is, you need to first calculate the amount called as the effective interest. So this method is called the effective interest method or the present value amortization method. How is that done? So this is the formula for doing it. Effective interest method produces a periodic interest expense that is equal to, I'll underline that for you, a constant percentage of the carrying value of the bond. I think we mentioned this also in the previous slide. You can have a look. So bond interest expense can be calculated in this way. The carrying value of the bond at the beginning of the period, every year you can calculate that, multiply it with the effective interest rate as calculated, and minus the face value of the bond into the stated interest rate. I believe you understand this one is the coupon amount, isn't it? So that will give you the amortization amount for every period. Let's look at that with an example. So let's say Evermaster issued 100,000 euros of 8% term bond on January 1, 2019, which is due on January 1, 2024, with an interest payable each July and January. That means it's a semi-annual bond, and investors require an effective interest rate of 10%. So effective interest rate is already given. You don't need to calculate that. So let's calculate the value. What is the maturity value? It's 100,000. So now we calculate what is the price today, so as to know whether there was a discount on the bond or premium on the bond. So the same method, first calculate the present value of the maturity or the face value of the bond, and the present value of the coupon on the bond. Okay, now why is the coupon taken at 4,000? Because this is a 8% bond, so 8% on 100,000 is 8,000, and since it is semi-annual, because you're paying it 2 times in a year, we need to divide it by 2. So you got 4,000 is the interest which is paid semi-annually for 5 years. So use that as a periodic sense, and then use the annuity factor for 5 years, and what you get is 7.7213. Calculate that amount. So the price of the bond today is 92,227. So the maturity value of the bond minus the price of the bond will give you the discount or the premium. So here you will see that the price is less than the face value, so the difference is called the discount. So here in this case it's the discount on the bond. Here let me show you how it was calculated. Okay, so first thing is you need to take the face value, that is 100,000. On that, calculate the table value. So look at the present value table for single payment, for the single sum. You need to look at that table at 5%. So go there. At 5%, it is yeah, it is, sorry, for sorry, I have to take double the period. I'm so sorry. At 5% for 10 periods. Okay, why 10 periods? Is because here, yeah, it's because you're actually paying it 2 times in a year. So this is where you got 61,391, because you're going to receive this payment after 5 years. Again, use the annuity table. I'm sorry, use the annuity table here. I'll underline that for you. Annuity table, and then take the number that is semi-annual payment of 4,000 at 5% for 10 periods, and that should give you the amount 30,887. Okay, so here if we were to prepare a schedule for amortization, here note that on the payment 4,000 was the payment of coupon every period. Every period you're paying 4,000. However, of that your actual interest expense would be more. In this case it is 4,614, while 4,000 will be the cash, 614 would be the amortized amount which you need to take forward, and every year you calculate the carrying value. The carrying value is calculated in this way. You could say 92,278 minus this value 614. No, I'm making a mistake. One second. Not minus, we need to add. Okay, so this add the amortized amount will give you the carrying amount for the next period. Okay, so every year you do that. For this amount, add to this will give you the amortization from will give you the carrying value for the next period. Okay, so next, what is the journal entry you need to pass? On the date of the issue, you pass the entry for receiving cash 92,278, and on the amortization date, let's say at the end of the period, you will amortize it as interest expense 4,614 and bonds payable 614, while the actual cash paid is only 4,000. Fine. Okay, so this is for actually converting the amortized sorry, this is for accrued amortization of discount for the next period. So in this case, interest expense is 4645 and 4,000 is the interest, and the bond payable is 645, and so on. It will go forward to every period. Here the same scenario stands when we talk about premium. Note that premium, the situation to discount. Let's take the same scenario. Let's say it was a company issuing a bond for 100,000 euros at 8%. On January 1, and with the interest payment 2 times in a year and so on. Fine. So the only difference is that the effective rate is 6%. So in that case, let's see what happens. Take the maturity value of the bond and calculate the price of the bond by taking the present value of the maturity payment as well as the coupons, and you got 108 530. When you see this, the maturity value or the face value is less than the price. The difference which the company has actually received is called the premium. Okay, so use how to calculate for the premium, also the same method. Use this for in this case, if you see, this is the effective interest rate is 6%, so we will use the 3% here, because half of that is half of 6% is 3%, and double the number of periods. Instead of 5 years, make it 10 years. So this is where you got the values from, 74,409. Similarly, go to the table of annuity and then again see 3% for 10 years. Okay, and then that's how you will be calculating the value, 34,121. Add up and then you got the value. Okay, so now if we prepare the table, again the same idea. 4,000 was the discount amount, but was the amount that was paid, but actual interest only came to 3,256. How did we get that? That is 108 530,000 into 6% into 6 into half, or 6 by 12. Okay, so that will give you the actual interest payment. Here you will see there is an amortized premium amortized, so you got a premium amount of 744, and then when you add this number, when it is a premium, you need to minus, so this minus this would give you the, okay, I'll put a minus here, will give you the carrying value. So when there is a premium, you need to minus the premium. When you have a discount, you need to add the discount to get the carrying amount. Fine. So with that, let me go ahead, and the journal entry on the date of the issue would be cash 108 530 and bonds payable 108 530. Now you need to amortize it further at the end of the first 6 months. So your entry would be interest expense is 3252 and bonds payable 744. Cash is 4,000. That's how you got adjusted. Now, what happens if Evermaster prepares the financial statement at the end of February? Rather, it's not going to wait till the end of the year, but it wants to prepare its statement at the end of February. Note that February is in the middle of the year. In that case, you just need to appropriate the number of months to get that figure. Okay, so if let's say the accrued interest was 4,000 for 6 months, then for 2 months it would be by 2 by 6, you will get 1,333. Similarly, even the premium amount will be done for 2 months. So 2 by 6, that would be 248.48. So the difference between that is 1,085.33 euros. That is the interest expense for the 3 months ending February. And the entry that you will pass will be interest expense 1085.33, bonds payable 248, the notes payable is 1333. Okay, so if bonds are issued between two interest dates, in that case the bond investor will pay the issuer the interest that is accrued from the last interest payment date to the date of the issue. On the next semi-annual interest payment date, bond investor will receive the full 6 months interest payments. Okay, like for example, in this case, assume this company has a 5-year bond dated 1st of January 2019, and on May 1, at par, which that is 100,000 euros, the issue of the bond, the entry between the interest dates will be like this: cash debited, bonds payable credited for the amount of the bond, and the calculation of interest, I think by mistake it went there on the top. Can you see it's here? Calculation of interest with 100,000 into 8% for 4 months is 2667. Interest expense is 2667 if you're making the payment on that particular date. When the bonds are issued at par, let's say on July 1, after 2 months after the date of purchase, they paid an interest to the investor for the 6 months, and that is the interest. So interest payment as calculated in the numbers there is 4,000, cash 4,000. So if you're preparing your interest expense account, it will look something like this. You will say interest expense will be debited with 4,000 as in here, and you already saw that in the previous period it was actually credited with 2667. So now next we'll call about if it was issued at a premium or a discount. So assume that this company Evermaster has 8% bonds. It were issued in May 1, 2019, and there was a yield of 6%. So now how do you differentiate? You can see when you see this 8% bond, this one refers to the coupon, and 6% yield is the effective interest rate. Thus the bonds are issued at a premium of 108,037. So the issuance of the bond will be like this. Excuse me. Cash debited, bonds payable credited. For the interest, cash debited and interest expenses credited for setting of the interest receipt. So bond issued at a discount or a premium. Evermaster then determines the interest expense from the date of sale, not from the date of the bond. So interest expense is the carrying value of the bond multiplied by the effective interest rate. So carrying value of the bond in our example is 108039 into the effective interest rate. It is 6% for 2 months. Okay, so that is actually effectively coming for 1% of this amount. So 1080 will be the interest for the 2 months. So if it was a premium amortization of the bond, then the situation looks like this. You would say interest paid on the bond. I think that's a mistake in the date. I'll just cross it out. So $100,000 euros into 8% for 6 months, that is 4,000. We already saw that calculation. And the cash received during May, again I think the date should be 2019, is 2667. When you minus that, you got your net cash paid, that is 1333, minus the bond interest expense for the last 2 months as calculated in the previous slide. So here you saw 253 is the premium amortization. So here let's do the entry for that. Interest expense is 4,000 and the premium amortization is bonds payable and interest expenses credited 253 euros. Okay, we'll go ahead with our next learning objective. I hope you understood the various aspects of bond issue at a discount, issue at par value, and issue at premium, and maybe consider what is the effective interest rate method in representing the bonds on a financial statement. Before I go to the next part of this chapter, you can take a break here because I'm thinking that I will just continue the whole chapter in one stretch. You can take a break. Please break it now. Take a break and then come back when you are ready for the next part of the chapter. Okay, here this part, as I told you, I'm only going to take the theory part. Long-term notes payable. This is a second example of non-current liabilities. It is similar to accounting in bonds. There wasn't much differences, and I didn't want to repeat the whole thing again. So I just said, okay, let's just do the theory part and go ahead with the extinguishment of non-current liabilities. So a note is valued at the present value of its future interest and the principal cash flow. Company amortizes any discount or premium over the life of the note. So can you see these 2 points are similar to the bonds. Next, I'll just take one special situation in the notes payable. So sometimes notes payable can, most of the time, notes payable are issued for cash. That is, the company takes the cash, signs a note, and makes it a liability. But sometimes the company can also buy property, goods, or services in exchange for note. While exchanging the debt instrument for property, goods, or services in the bargain transaction, the stated interest rate is presumed to be fair unless no interest rate is stated and the stated interest rate is unreasonable or the stated amount is materially different from the current cash price for the same or similar item from the current fair value of the debt instrument. Okay, so most of the time it is considered that it's okay to deal with the particular lender of property, goods, and services and give them a promise of making payment in the future. That's all right, but then as companies are doing that, auditors especially need to be careful to make sure that when the interest rate has not been stated, then it may not be a fair deal. Okay, so there could be something fishy about it. So what about the choice of the interest rate? If the company cannot determine the fair value of the property, goods, and services or any other right, or if the note has no ready market, then the present value of the note must be determined by the company to approximate an applicable interest rate. This is called as imputation of the interest rate. See, in most of the real world transaction, a particular interest rate is always considered to be implied. Now, if it's difficult to find such an interest rate, in that case, imputation would be used. So, choice of the rate can be affected by the prevailing rate for similar instruments or any other factors like restrictive covenant, collateral, payment schedule, whatever is the term between the two parties. Next, we can talk about mortgage note payable. Now, it's also a note payable where you're giving a promissory note. But for a mortgage note payable, an additional requirement is that you're also pledging the title to a property as a security for the loan. The best example I can give you here is, let's say you go to a bank to take maybe a home loan or maybe a car loan, then the property title will be handed over to the bank because you're mortgaging that property to the bank to get the loan. Same type of transaction happens in the real world for companies. A common form of long-term, it's a most common form of long-term notes payable. It's payable in full at maturity, or sometimes the company will be paying it in installments. It has a fixed rate mortgage, or it could be a variable rate mortgage. Now, fixed rate mortgage is that interest rate is fixed and the same rate of interest is to be paid by the company over the life of the uh, notes payable. Or it could be variable rate, it may depend on certain other rate. Okay, I come to the third objective now. The third objective is extinguishment of non-current liability. Now, I want you to understand that long-term liability or non-current liability are actually going to be in your balance sheet for many years. Again, depending on the agreement, the values may increase, decrease. Sometimes there could be amortization of premium or amortization of discount and so on. Those things would be adjusted accordingly. However, how do you how when a particular value of non-current liability is appearing in the balance sheet, as users of the financial statement, you need to understand what does it actually mean. So there are three common situations besides payment at maturity which can happen. So if the cash has to be paid before maturity, it's sometimes possible, maybe because of some reason, maybe you broke the promise, or maybe the conditions or the covenants were not kept, or for any other reason, or maybe the company feels that they don't need that loan amount anymore. They may actually extinguish the liability before maturity, or they may extinguish the liability by transferring assets or some securities. And the third scenario is that maybe that liability can be extinguished with some modification of terms. If you remember, we talked about this in the previous chapter when we were talking about converting a current liability to long-term liability. Fine. So extinguishment with cash before maturity. In that case, you need to consider two things. If the net carrying amount is greater than the acquisition price, then you say there is a gain. For example, let's say if the carrying amount is 1000, but now you have to just pay 800 to settle the uh, loan or to settle the liability. In that case, you would say that this scene has led to a gain to the company and they have to represent that in the financial statement. Opposite scenario, if the reacquisition price is greater than the carrying value, then there is a loss. At the time of reacquisition, unamortized premium or discount must be amortized up to that date of reacquisition. This is just like, remember when we talked about depreciation, if the depreciation was not charged till the date of sale, you have to first charge the depreciation and then sell it. Same thing will be here, the same idea. Let me continue with with an illustration. Evermaster bonds issued at a discount on January 1, 2019. These bonds are due in 5 years. The bond have a par value of 100,000 euros, a coupon of 8%. So they've clearly given its coupon and it's paid semi-annually, and the yield is 10%. So what do you think here? This is again talking about a bond. Its coupon is 8% and the yield, or we can say the required rate, is 10%. Now, what do you think should be the price of the bond? I want you to think about it. Okay, fine. So, suppose they prepare a schedule of the bond discount amortization. Then, how would that look like? First of all, they calculate the interest amount by the price of the bond, that is 92,287. Consider that we have already done this before. So now they are talking about a particular payment. Let's see. So here they're saying 2 years after the issue date, on January 1, 2021, Evermaster calls the entire issue at 101 and cancels it. Now what does 101 mean? It means 101,000. Okay, so let's see, on that date what was the carrying value. So 1/1/2021, it's already been highlighted in red. So the value, the carrying value was 94,925. And what is the settlement value? It is 101,000. So could you see that the reacquisition value is more than the carrying value? In that case, this is a scenario of loss. And what entry would you pass? You will pass an entry for loss on extinguishment. So bond payable 94,925, that's the carrying value. Loss on extinguishment 6,075, and the price that you have to pay cash 101,000. Clear? Okay, so next we'll take another scenario where you're going to extinguish the non-current liability by exchanging it with securities or assets. So creditor should account for the non-cash assets or equity interest received at their fair value. Debtor will recognize the gain, which is equivalent to excess of the carrying amount of the payable over the fair value of the assets or the equity. So let's take an example here. Let's say Hamburg Bank loaned 20 million euros to Bond Mortgage Company. Bond in turn invested these monies in residential apartment building. However, because of low occupancy rate, it cannot meet its loan obligation. So Hamburg Bank agrees to accept from Bond Mortgage Real Estate with a fair value of 16 million euros in full settlement of 20 million loan obligation. The real estate has a carrying value of 21 million on the books of Bond. So how do we record this transaction? Okay, so can you see there are actually four figures here. The original value of the loan was 20 million, but today the company is not able to pay, so the bank agrees to take 16 million in exchange for that 20 million. That's the loan value. However, the company also calculates that the bank calculates the carrying value, that is 21 million euros. So the entry would be for both extinguishing of the loan as well as loss or the gain on what you say repayment. Okay, so how does the a company calculate it? So the note payable to Hamburg Bank is 20 million. This is what you settled now for. Loss on disposal of real estate, because real estate the value was 20 million, but you were not able to uh, consider that. Okay, so let's see how did you calculate it. By taking the carrying value of your real estate, that is 21 million, and the gain on extinguishment of debt. Okay, so that is 4 million. Okay, how did you calculate this 4 million? You calculated this 4 million by the difference between your original value of the loan to 20 million and the value that you actually have to pay. You only have to pay 16 million is what they said, right? So basically the company has now acquired the asset, so the value of the asset is considered to be 21 million. So the bank did not receive any cash. Instead, this company has to give away the real estate. So they gave away the real estate at the carrying value of the estate, that was 21 million, and 4 million was the gain on extinguishment of debt, because debt was 20 million, but the bank has agreed to take 16 million. So 4 million is the gain. Add this and then minus the note payable. What you will get is 20 is 5 million, which will be the loss on disposal. Fine. Let's now assume that the bank has agreed to uh, accept from this company a mortgage for sorry an ordinary share of 320,000, €10 par value, and it also has a fair value of 16 million euros for full settlement of this 20 million loan. So here the idea, if you can notice, is the same. The company is issuing shares instead of taking the real estate. So the entry would be again similar. You will take the notes payable. The original value of the note payable was 20 million, while instead of that you will be getting ordinary share. 320 into 10 is 3,200,000, and the remaining value will be the premium that you're paying for the shares that you purchase. So 12,800,000. Notice the total of this should be 16 million, because that is what the bank has agreed to consider. Okay, the fair value is 16 million, and the difference will be gain on extinguishment of debt. Fine. So if there was some modification of term, remember this is the third condition. So in this case, what would happen? The creditors may offer one or a combination of following modification. First one is reduce the coupon, or maybe extend the maturity date of the face, or reduce the face amount of the debt. So there are three ways, or even a reduction or deferral of any accrued interest. So these are the four ways in which the company can modify the terms, make it easier for the credit debtor to make the payment. So on December 31, 2019, Morgan National Bank enters into a debt modification agreement with Resort Development Group. The bank restructures a 10,500,000 yen loan receivable issued at par, interest paid to date. Excuse me. These are the agreements. One is reducing the principal obligation from 10,500,000 to 9 million euros, extending the maturity date from December 31, 2019 to December 31, 2023, and thirdly, also reducing the interest rate from an historical effective rate of 12% to 8%. Given resorts development's financial distress, its market-based borrowing rate is 15%. What happens is, as the company is not able to pay, then their actual payment their interest percentage, or the available percentage in the market will actually increase. So this is why it is 15%. Fine. So let's have a look at that. For restructuring, what you're going to do in this case, first calculate the value of the restructuring. Now the payment date has been postponed to 4 more years. So instead of 2019, it's now taken to 2024. So there are 4 more years to pay. So take the PV, or the present value of 9 million for 4 years at 15%. That is the required rate for this company. So you find it's 0.57175. So this is 5,145,750 yens, and the present value of 720,000 yen interest payments. How did you calculate this one? This would be the interest payment according to the current interest rate, that is 4 years at 15%. Take the annuity value of that, and that is 2.85498. So that would be 2,055,586. Add these two, and that will give you the value of your note. Okay, so that is 7,201,336. So with that value, the gain on the modification is 3,928,644, which is the difference between your previous carrying value, that is 10,500,000, and the current carrying value, which you just computed in the previous slide. So what is the entry? The entry would be the note payable original 10,500,000. The gain on extinguishment, that is the difference as you saw in this slide above, and the new note at its present value 701,336, and that would give you the entry. If you also need to calculate the entry on interest, so you will notice that interest expenses is 1,80,200. That is calculation based on current value, that is, the current carrying value. If you could see, this is the price at which you sold the note, multiply by the interest rate, that is 15%, and that will give you 108 to 1,080,200. Okay, so that is the amount you calculated. And the notes payable 300,000, sorry, 360,200. So that is the amortization rate. How did you get that? When you take the cash paid minus the interest payment, you get the amortization rate, and the difference would be the cash that you actually paid. Okay, so at maturity, when the time comes for repayment, then the entry would be note payable 9 million and the cash would be 9 million. This is how you will be making the payment. So with that, we actually finish the main part of the chapter. Here, lastly, we'll just take very briefly talk about how would you represent these non-current liabilities on the financial statement. The main idea here is that when the companies have an option to record fair value, especially for their financial assets and liabilities, bonds, notes payables, and so on. Under the IASB, it was believed that the fair value measurement for financial instruments like financial liabilities, they would provide more relevant and understandable information than amortized cost. So you could earlier it was understood that it's possible to make a fair understanding of the values of especially the non-current liabilities by just providing the fair value. So what does this fair value actually mean? No, non-current liabilities are recorded at fair value with unrealized holding gains or losses reported as part of the net income. So if there was any amortized gains or losses, you need to show it in the income statement. Let's take an example here. Let's say Edmund SE has issued 500,000 euros of 6% bonds at face value. Edmunds chooses the fair value option for these bonds. On December 31, 2019, the value of the bond is now 480,000 because interest rate in the market have increased to 8%. Now, in that case, if you will see what has happened, the value of the bond actually issued was 500,000, but now the fair value is only 480. It means now you have to consider the unrealized, we can say gains in this case, from the change in the value. So this one would be reported in this way. Bonds payable would be debited and unrealized gains or losses, which is an income here, would be credited with 20,000, the difference between the original value and the fair value. Okay, but sometimes there is also a concept called as off balance sheet financing. Off balance sheet financing is sometimes the company may have borrowed money, but it may not be represented in the balance sheet. This is possible with certain means. Okay, like for example, when they have some unconsolidated subsidiary, that is, they have a subsidiary, but they are not considering their balance sheet or their financial statement in consolidating the financial statement of the company. So they could borrow from such a company and still not I mean they could borrow from such a company and then there wouldn't be any evidence that such monies were borrowed, or they could create a special purpose vehicle, or we call it as an entity. They create an entity which is meant to lend lend some amount of funds to the company so that it becomes their own special purpose entity and they don't need to report it as an outsider. Now, why does the company do off balance sheet financing? Okay, I would want you to look at this item especially for your exam, is what is off balance sheet financing and how it is done. Okay, and what is the reason why it is done. So let's see what are the rationale. First one is when you want to remove the debt, because when you remove debt, it enhances the quality of the balance sheet and it permits the credit to be obtained more readily at less cost. So see, if you have borrowed money but you don't want to show it in the balance sheet, what does it mean? It means that your balance sheet shows a much healthier position than what it actually is, doesn't it? Or the loan covenant or often limit the amount of debt a company may have. These type of commitments might not have considered in computing the debt limitation. Remember, whenever the company borrows money, especially from lenders who are more powerful, they may have to agree to some covenants or some restrictions. These restrictions will be more strict if the company has more loans. In other words, if its debt ratio is weaker. So some argue that the asset side of the balance sheet is severely understated when they do that. Of course, this is true when the company actually shows lesser assets, then automatically its asset will also be severely understated. So how do they present it? Normally, the company has to make a exhaustive disclosure. Remember, when we use the word disclosure, what we mean is that if the item cannot go into the financial statement, then it must be disclosed in the notes to the financial statement, isn't it? So the note disclosure generally indicate what are the things they have to mention. They have to mention the nature of the liability, the maturity date, interest rate, provisions for any calls that the company can have, conversion privileges, restrictions that are imposed by the creditors, or any other thing that can impact the decision of the reader of the financial statement, like assets designated or pledged as security for a particular non-current liability. Fair value should be disclosed, and also any future payment that has been done for a sinking fund. Now, sometimes what companies do is, they keep aside certain amount of money every year so that when the maturity comes, they can make the payment. Okay, so this also needs to be disclosed in the notes to the financial statement. Also, the for the next 5 years. Okay, next is the analysis part. Again, this is a repetition of what you have already studied. So very quickly, I'll tell you. You can use formulas, or we can say ratios, like solvency ratios, debt to asset, liabilities by total assets, times interest earned, where you take income before taxes and interest expense by interest expense. It tells you how many times of your interest expense did you earn in your net income. Okay, so here is an example and the solution to that. Please have a look. This is from the textbook. This is from the Novartis example just given here above in the illustration. So you need to understand what does this 41% mean and what does 29.9 times mean. Okay, with that, I will end the chapter. I know it has been a very long chapter, but hopefully you will have learnt a lot. Please do let me know if you have any questions. Have a lovely time. Thank you.